Good morning, ladies and gentlemen. Well, the risk dial closed at 86 on Friday. What's interesting to note is how the volatility that we had this week impacted the model scores so little. They just went up 2, down 2, but it just shows you that all these moves down are corrective moves within a very strong uptrend. There is no sign that this is going to resolve itself anytime quickly. So I think that the most likely scenario is one of continued whippiness in the market, but overall the prices still keep on going up. We'll naturally examine that in much more detail later on. But my main takeaway for this week is how the bond market actually refused to steepen the curve, and that is what we will look at next. The 2s 10s actually made a new low on the move before retracing slightly on Friday, but you can see that we are basically destined to trade this 99 to 100 level, which is where we were at the beginning of the year. The fact that we will have given up all the steepening since the beginning of the year is, to me, very interesting. It will basically negate the whole move up in bonds and the weight that had on growth. So at some stage, this is going to foreshadow another movement up in growth. But for the time being, let's keep on watching it. And really this kind of level around 100 should produce a decent retracement back up to about 119, 120. And much the same in the 5s, 30s. If we look at what happened on a daily basis on the 5s, 30s, we can see that basically the curve was flat. I anticipated that it would steepen slightly because having had this huge move up, which basically touched the 109 level, I expected that we would go back towards 130 before retrying the 111s, but we are absolutely refusing to move more than 1 or 2 basis points on the 5s, 30s. If we have a look at that on a weekly basis, you can see, what have we moved? We have moved absolutely nothing, showing that this 124 level is going to be important. If CPI can't steepen it through 124, I think the next most likely move is significant flattening of the yield curve again through 105, basically going to this 81 to 83 area. And that is going to be very, very important for growth, and it will give it a big boost, and it will be very bad for things like XLF. One step at a time, though. If CPI is not going to be able to steepen this curve, then I don't know what will, because if we have reached peak inflation, that actually means that the curve can absolutely continue to flatten, and the 30s can keep on outperforming the short end, the 2s and the 5s, and that should be a big boost for growth at some stage. The other thing that I'm looking at and will continue to look at like a hawk next week is this, which is 10s, 30s. Having broken out of this quadrant here into this area, which shows that the market is really not afraid of inflation, the next step is to see if you can break above this 56.5 basis points, which basically leads it to something like this. And that is what people are really not expecting. That is the pain trade, where the 30s keep on outperforming the 10s, showing no fear of inflation, in fact, fear of disinflation. And that will be absolutely the pain trade. Nobody's expecting that. I wasn't expecting that, but I am very much aware of the possibility, because if CPI can't steepen the curve, I really don't know what will. we are reaching the period where inflation is going to be at its highest. And if the market truly says that this is very transitory, then we can have a bit of a melt up like here back in 17, and that really will have a big effect on asset prices. I will be looking at this weekly close level around 56, 56 and a half like a hawk. It could be very, very important and give us some very major clues. In terms of outrights last week, since the curve didn't really move, was fairly boring. Fives, I still like the least, and that is why I'm afraid that the curve will flatten. There's very little value in the fives unless we start thinking that the Fed is no longer going to taper and is no longer going to be hiking rates sometimes in 2022 or 2023. I don't see why they would change their mind so quickly, and therefore every time the fives come to a level in the, let's see if we can enlarge this, come to the Bollinger Bands, it's quite natural to think that they will go back. And basically we're just repeating this pattern here. The interesting one is the 30s, and as you know, I did short bonds here, bond futures, and I'm looking for a retracement, but what puzzles me is that I would have thought that the curve would steepen and that the 30s would react most, but that isn't so. The curve is doing nothing. And that tells me to be careful with my short, because on Tuesday when we get CPI, if we can't get the bonds back up towards 220, they might easily collapse all the way down to 163. This is going now to be a bit of a pivot point, and if all we do is go up to here 206, 207 when the CPI number comes out, or 204, 205, and the CPI number is actually weaker than expected, or sort of weaker than expectations, there is a strong likelihood that we could break back down and start going down towards this 163 level. So I'm going to be very, very careful. I will probably on Monday get out of most of my bond shorts. And I'm puzzled because when I put on a position, I expect the yield curve to do something, and when it doesn't do it, that probably tells me more than anything, and that is that the market is probably much more bullish longer term of bonds than I'm giving it credit. So I will naturally be watching like a hawk on Tuesday. I think Tuesday is going to be very, very important, because if the yield curve can't steepen, it must flatten. It's just not going to stay where it is, and that is going to have big implications. While the yield curve did nothing in the US, it continued to flatten, and quite substantially, in Europe. This is now the Bund. You can see that I thought that the Bund had, if it broke this minus 26 level, 25, that it had an opportunity to go all the way down to minus 38. Well, it got to minus 34. So it did have, the 10-year, the Bund had quite a substantial fall. If, on the other hand, we now switch to the bubble, you can see that the bubble closed the week very much unchanged to slightly higher in yield than it started, while the Bunds had a decent fall. So if we go back to the Bunds, this is the chart of Bunds, 1, 2, 3, 4, 5 days. You can see we started around the minus 23 and finished around minus 29, so 6 basis points, while the bubble slightly higher. The yield curve is really, really flattening in Europe. And that is a cause for concern in terms of what the US will do. I think, I keep on saying the bubble is the least attractive of all these contracts, and the one that is probably the easiest to short at good levels. It got to the minus 64 level, bounced like a bitch. So to me, every time the bubble gets to a significant level, it's time, risk reward says be short of it. The other contracts you have to be very careful with, because if we go to something which is now quite clear, like the French contract, this is the OAT, you can see how beautifully it's come back, filled this gap that we had. Now it's in a position to do something very, very interesting. It could either go and probably tried all the way back up to minus 28, or if this is all a failure, we could actually go down here to minus 29. This is why I'm saying next week is going to be a very important week for clues to what the yield curve wants to do. If the French contract now starts breaking through these levels, we are going all the way back to minus 19. And that will have consequences for the Bund, it will have consequences for the curve against the bubble, it'll have consequences in 5s, 30s, it's going to have consequences in 10s, 30s. And if those start flattening substantially, then we just are going to have a very different world in asset prices, and I will show you later what could happen. But really, if you have a look at this chart, which says, we are now tied completely, we're going nowhere in the relationship between Europe and the US. That means that anything that happens in Europe is going to be transmitted into the US, and anything that happens in the US is going to get transmitted to Europe. That means that I'm really not afraid that these contracts are going to now separate magically. They're going to be very, very tight within a couple of basis points, and that what happens on one side of the Atlantic is going to be mirror imaged on the other. So that is why I'm saying that it's going to be very interesting what happens next week. The US dollar continues to be the ultimate pain trade. If you trade it, you'll get pain. I think the situation is becoming quite clear that this 92.62 to 93.14 area is very, very important. If it doesn't get through there, it'll come back down towards 91.01. I can't get bullish on it for macro reasons, but I recognize that if it does get through 93.14, then it probably has a run to this moving average, which is around just short of 95. And I think that next week will probably give us a fairly good signal about what the dollar wants to do. I have not changed my mind. I am still bearish dollars. I just don't know what level I'm bearish dollars from. I would have thought that if we see this kind of 95.07 area, that is going to be a great opportunity to get short of dollars, simply because everyone will be talking about inverse head and shoulders and rubbish like that. And really at this level, everybody will be stopped out. Absolutely everybody will be stopped out. And that's probably the best way to, best place to look for a substantial dip in the dollar. If we translate that to Euro USD, I still haven't changed my mind. If we see this 115.40 level, I think that is going to be a great place to be long from, because absolutely everyone will be saying this is a head and shoulders, and we are now going to be going much lower. I don't see it. I don't see why that should happen. I really can't see that the US is in a position to allow the dollar to be much stronger than it is from a fundamental macro point of view, but I'll be wrong. But I will still be looking for long euro positions around the 115.50 area. In the meantime, I'm leaving it alone. I see absolutely no value in in getting chopped up in this humongous chop within a couple of percent. with the dollar doing basically nothing and the bonds at a pivotal week, because the yield curve will move next week for sure, I see absolutely no point in doing anything leveraged in gold. It respected the 1764 level, never really closed below it, and it's retracing up into the 1800s, into the low 1800s, where it's meeting the negative now sloped 200-day moving average and 50-day moving average. So as I keep on saying, anything 1810 up to 1830 is a get out of anything that you bought below. I can't see that this is going to be clear which way we're going to be trending in gold for quite some time. And therefore, there is absolutely no point in jumping the gun. You'll just get, murdered in the chop. It does seem to me that odds are, for now, that we have seen the low. But, I'm not as confident of that as I was, simply because if CPI is very high, we will have a reaction in bonds, and we will therefore have a counterintuitive reaction in gold lower as well. We will see. My fear actually is that we will see a CPI which is lower than expected, and that will actually be a decent boost for gold. But it's quite clear that unless it starts closing above 1835, and I can actually it really needs to start closing 1870s and higher for it to even start looking remotely bullish. I would have thought that we are stuck in this range for quite some time, while the bonds make up their mind, the yield curve makes up its mind, and the dollar makes up its mind. To me, this is indecision, and we could be in this kind of chop until the end of the summer. I keep on thinking that DBC is actually a better long than gold, simply because it's acting well. It keeps on coming into the area of value, or the swing area, which is 1868 to 1841, and keeps on holding on a closing basis. Therefore, I really can't say that this is a bearish look. It could be a significant slowdown of the trend, but it's definitely not a bearish look, while gold is nothing like it. So energy looks like a better hedge for inflation than gold at the moment, and I think it'll continue to be so. I would have thought that any dip into this area is a decent risk reward long, simply because if it closes through it on a weekly basis, you just get out. And it's just a better risk reward trade than gold at the moment. SPX is respecting levels fantastically well. This is my favorite 195-minute. I've drawn in a new level at 43.18, let's call it, and that basically is another support level. You can see what happened last week. This is the big dip, which actually touched 42.90 precisely, bounced straight up and closed above this previous low at 43.18, never closed below it again, and on Friday we just rallied like crazy. To me, this is going to be another important level, 43.18. The really important level to me is 42.90, 91, but still I think 42.55 is the important level. As long as we're not below that, then all this is just corrective, and we are still in a very good uptrend. you can see on the dailies that that is very much so. As long as we are above 42, 55, 56, there is absolutely nothing to be worried about here. And that is as simple as that. Where is resistance? Well, resistance is really at the weekly Bollingers and this kind of trend line. I'm not a great believer in trend lines, which is, roughly the kind of channel that we've been in for a long time. And that comes in around what next week will be 4,450. That's it. That is where resistance is. If I wanted to sell something, if somebody said, Nick, you've got to pick a level to short it at, I would pick that level. Anything else, while we are above, the previous close that we respected around the 42.32, 42.50 area, to me, as long as we are above that, we are in an uptrend. In all time frames, as you saw, weekly, daily, 195 minute. I can't fight it until we start showing some real divergences or signs of topping, and we're just not doing that. Every time it dips, it touches a level perfectly and comes right back up. We know what these levels are. I keep on posting them and they keep on working. If that is the case, why stop something that works? In NQ, we have a new level. This is the previous high, and this is where we dropped to, and the support held beautifully, and the market decided that it wanted it there. 14,575. Underneath there is absolutely nothing until 14,044. That is still a very, very important level, and I guess it matches the 42.50 level in the SPX now. A note of caution is that we've gone up 8 weeks on the trot, which is very unusual. But, we could have just a sideways week to down week and then keep on going, like we did something like here in this area. So that doesn't really mean very much to me, but I'm slightly cautious, and I'm glad not to have a significant position in NQ, because next week will be pivotal, because the yield curve will do something and we will try to take advantage of it. If we look at the tech spreads, I think they are saying just as much as I've been saying, that the yield curve is going to be very important next week and that it will move. So this is XLF over XLK. You can see how it's come back to the upward sloping moving average, which basically means it's either going to go all the way back up to 27 over the course of the next couple of weeks, or it's going to start keeling over, going towards 22, and then it's going to start turning the moving average, and we could start seeing new lows in the XLF XLK. So whatever the yield curve does next week is going to be pivotal for this. And also, if we have a look at NDX over DJI, I had the good fortune to get out right on top of the line. It hasn't come back very much, has it? And now it's going to do one of two things. It's going to either come right back to the moving average round here next week, and you can see all this line of highs and lows right here, or it's going to bust through the 42.91 and keep on going and start making new highs. And that is going to be decided by what the yield curve does next week. So that is what we'll jump on board. On to the Nikkei, which I'm saying you have to pay attention to, and then I didn't pay attention to it, and it touched the 200-day moving average. It touched this trend line which has been there for decades. I swear I haven't moved it. And straight back up 1,000 points. What can one say? I think that the Nikkei is something that we have to pay attention to, and that is likely to show us the next big move in equities. It really would not surprise me if it did something very exciting next week. I don't know what, but I'll be watching it like a hawk now that I've learned my lesson and that I should have left the bid there. And I had two chances, two bites of the apple, and I failed. So I will be really watching it, because I think it's going to be a leading indicator very soon. It's done nothing all year. This is a weekly chart. You can see where we started the year right here. It keeps on trying to go at zero for the year and keeps on failing, in which case something that keeps on failing to go down usually ends up going up. This is probably the ultimate value index. So that will tell us which way value is going to go against growth in a very short period of time. I keep on saying that you have to watch Nikkei. You have to have something on board, because it's showing a very interesting technical pattern. And let's have a look at it now on a spread to US. And here we have the SPY over EWJ. That means you're taking out the FX component. It's right at the highs of this trend line, which has been holding since 2008. And at this kind of level, if you don't prefer a little bit of Japan to diversify, you are probably wrong. This is the really important level, the 4 level, which has held since 2008. While above it, it is, US is outperforming, but it's been in this channel for such a long time, over 12 years, that I really don't see that the odds are not that it could come back down. And Nikkei at this level is really not a bad longer term investment. It just isn't. The other spread that I wanted you to be aware of is SPY over IWM, so over the Russell. And we are right back to the levels that were so pivotal for the past couple of decades. I mean, I can go back. You'll see this 193 level has been the high there or thereabouts since 2008. So, whether it's here or here, what's that? A difference of about 4 or 5%. You are at a level that, if you ignore the COVID panic and back again, that has always had a retracement and has been the high in the relationship between SPY and IWM. So this kind of area might be very interesting for a return back down towards 182, and that is a good 10% move back down in that spread relationship. This again is going to be determined by the yield curve and what it does in the next couple of weeks. And that is why I keep on saying that I think this CPI data is going to be very important, because it's going to move the yield curve and give us the hints of where we need to be positioned, whether it's growth or whether it's value. Who knows? It just that all the spreads have gone back to very important and interesting levels, and they will either accelerate through them or they will collapse back down. So that is why I'm saying next week is going to see some big moves, certainly in these spreads caused by the yield curve. Just like the Nikkei has diverged so much against the S&P, so has Europe really, and I've been saying that for a bit. 39.86 still the very important level. We closed by a couple of ticks below it last Thursday, but straight back up on Friday. But it only really is going up to the moving average and then failing again. So it's quite puzzling how these divergences can keep on continuing to happen. The transports in the US have done nothing for 3 months. Europe has done nothing for 3 months. The Nikkei has done nothing for 6 months. While the US keeps on powering ahead, the SPX keeps on powering ahead, NDX keeps on powering ahead. And I think, it's likely that next week we're going to have the resolution of that divergence, because either these contracts keep on moving, get moving as well. The interesting one now, it becomes DAX, and I really am in 200 minds about that. Because as you can see, the highest daily close is 15,683, and the warning level is here 15,457. So we are in a very tight range that is going to bust at some stage. We are really sorry. I mean, that's probably the highest close there, 15,708. My mistake, 15,711, whatever it happens to be. So either we break out of this range on the upside, or it will be increasingly clear that these contracts just cannot hack it and that it has to be on the downside. I think that, again, is going to be decided next week. And it's best that we wait and we see what CPI is and what kind of a move the curve does, because really it should become much more obvious on Tuesday which way all of these contracts are destined to move. My favorite way is still to the upside in all of them to catch up with the US, but we will see that on Tuesday. And emerging markets are in the same boat as Japan and Europe, doing nothing, up, down within a very narrow range, bounded by 52.08, 55.83. While they're in that range, nothing much is happening. They need to bust out. But the interesting thing is, if you look at the spreads, you can see that this one is EM against Japan, very stable. This is against Germany, stable within a range of rising prices, and this is against Europe. The SPX, the stocks also relatively stable, right? This is the stability, and this is against the US, new lows. Just as there was hope, new lows. So the US is leading everything. Everything else is doing nothing while the US keeps on going higher. Whether this can continue, I think, will be determined next week. I just wanted to give one final word about volatility. It's becoming increasingly obvious that if we're going to see any kind of sustained pressure on the US, volatility really has to close above 2005. While it remains in this channel, 2005, 1558, everything is just temporary. Really, the signal that we are going to have some persistent pressure on SPX has to be that we close substantially over 2005 and we actually have follow through the next day. Until that happens, everything is just a short-term dip, and it's not worthwhile even thinking about it. The levels in SPX that I've shown you are just going to be respected and great buys unless we see daily closes above 2005 in volatility. As far as the bias levels are concerned, I've updated slightly the levels in the outrights in the bonds, but my view of the yield curve has really not changed. It what the Fed is trying to do is disinflationary and the curve is responding, I am going to be very worried next week for the curve if it doesn't start to steepen. If it doesn't start to, if you cannot steepen on inflation figures, then there is, what's it going to steepen on? And that could be a real big mover, something that gets the ball rolling for the next 2-3 months in terms of what is going to be bought in terms of equities. We have all the levels, we know what they are. Really, 2005 in VIX is going to be crucial if we're going to get any sustained pressure. If not, there is absolutely nothing to stop SPX trading 44.50. There's nothing to stop NQ going up. And especially if Nikkei can't, it can't break those levels that I showed you, I think we are going to bust through the 30,205 level at some stage, and that's going to lead the next wave up. I truly believe that. I'm buying Nikkei simply because it is at great levels, and I will not change my mind unless we see a close below 28,180 on a weekly basis. Thank you very much indeed, and tweet you on Monday.